screen. Let me see which screen is open. Okay, good. So any idea what exactly bond market is? Anyone? हमने अभी डिस्कस किया थोड़ी देर पहले. So bond is nothing, basically a debt which a corporate is taking from the investor. So now another answer to your question is say that venture capitalists say corporate take debt or equity. So corporates can take debt from investors like us also. How they take it? In the form of bonds or debentures, which is called NCDs, non-convertible debentures. Bonds are usually non-convertible debentures, right? And CD is convertible debenture. So how do the corporate take loan from us, and why that particular loan is not called as a lending, rather it is called as investment? So there was a difference which I discussed in the last class, which I would like to summarize in one simple line, that whenever we take loan, we always give certain guarantee or security back to it. That means in case we are not able to pay that loan, if we default that loan, the lender will always have an option to recover its money. That is what loan is. But if we take that thing as an investment, like venture capitalists, from them we take a loan or debt part as an investment. So the person, the venture capital is actually investing, and in investment, there is no guarantee or no security attached to it. Usually, it can be attached as per the indenture, whatever the discussion between the lender and the, or the whatever the discussion between the investor and the issuer. Because here we will make them as an issuer and an investor. The person who is lending the money will become the investor, and person who is getting the money, or the borrower, will actually become the issuer of the instrument for investment. This thing is clear. So major difference between the lending and the investment in debt side is that lending, it is backed by certain guarantee or security, and in investment it is not backed by certain security or collateral for that matter. Right? That is the major difference. Now a corporate wants to borrow money. What is the easiest way for the corporate is they can go to the financial institutes, they can borrow money from them. Now let's take an example of a simple bank. What is the business of a bank? They take deposits from in the form of savings account, current accounts, term deposit, that is fixed deposits, recurring deposits, and they lend money. When they're taking deposits, they are giving out some interest, and when they lend money, they are taking some interest. So expense outgo and expense incoming, that is the difference what they earn. So they earn higher interest incoming. That means when they lend, they give loans, they earn higher interest compared to what they give on savings account and current account and fixed deposit and recurring deposit. So that is their business, to get money from somewhere and to lend it to somewhere, right? That is their main business. Now when they're lending money, they're lending at a higher rate. So let's say for a corporate, they're lending at the rate of 10%, right? If we are depositing money into the bank and we are getting only 7% as a fixed deposit, that is almost highest as of now. Bank is giving at a 10%. So corporate who is taking loan is actually expensing out 10%. And we as an investor investing in FDs, we are getting only 7%. There's a gap of 3%. Now corporate says that I will lend you, I will give you this instrument, you invest in my company, I will guarantee to pay you back, and I will give you 8.5%. Will you invest with the corporate, the or the bank? Will you do a fixed deposit?
Corporate.
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 Considering that all the credibility of the bank and the corporate is same, because in banks also, the in case the bank goes bankrupt, then the guarantee of only 5 lakh is being taken by subsidiary of RBI. That means if you make an FD, fixed deposit, of let's say 1 crore rupees in the bank, and bank goes bankrupt, then only you will get a 5 lakh rupees guaranteed back. That's it, because that is an investment, that is not a loan you are given to the bank. In the same way, if you invest in this company and a corporate who is having the same credit rating as the bank is having, that also gives you the same guarantee that we will give you back money. So chances of default has been equal in terms of bank as a corporate. Here you are getting higher rate of interest, and it is a win-win situation for you and a corporate both, because corporate is shelling out 1.5% less and you are getting 1.5% higher. So you both are okay with it, because for you the safety of money is equal here as well as in bank. So you love to invest into that corporate bonds. So this is the way corporate takes loans. Now these instruments are basically called as bonds or debentures. Now what are the bonds and what is the bond market? How does this work? This will try to understand in this particular topic, right? So what is exactly the bond? Bond market is nothing, but it is a market for trading government, corporate bonds and tax-free bonds, where bonds like government also needs funds. So whenever like government gives us budget, so what the government says that we will be making roads, we'll be developing infrastructure, and we'll be doing this and that. From where does that government get money from? Government gets money from borrowings. How does government borrow? They issue bonds. What are those bonds? Those are government bonds, GSEC, government securities, right? So government issues securities, which are called government securities, which are the bonds, which are nothing but bonds. Government says you invest into us. That means you give us money, we will give you interest. So government borrows from us in the form of government securities, right? In the same way, corporates also borrows from us in the form of bonds. So these bonds are written agreements, which actually says when we will be getting our money back, when we will be getting our interest, what is the security, because there are some secure bonds also, what is not the security. So everything is defined into it. Since this is a debt instrument, so everything is defined with this particular instrument of investment. And when you get this particular thing in your demat account, then you are liable to get a return fixed on it, which is already fixed on it, right? So these are called bonds. It is a fixed instrument in ki volatility is very less. These days interest rates are fluctuating very sharply, so definitely we are seeing a lot of volatility in the debt market or the bond market also. But usually in the stable scenario we don't see much of the changes in the debt market. We'll understand how these changes are coming in the coming sessions, right? Objective, what is the objective of bond market? Is access for long term capital for corporates and government. Usually when we talk about these bonds are usually, I'm not saying every time, usually these bonds are for higher maturities. Does that mean that there are no bonds for the shorter term maturity? No, there are lot of bonds which are from shorter term maturity also, which is a maturity from 1 day. So we have bonds or we have debt instruments for investments where we have maturity, where the maturity ranges from 1 day to 10 years, 20 years, and 30 years also. So 1 day maturity till 1 year maturity, those bonds are usually called as money market instruments. So whatever instrument which is having a maturity ranging from 1 day to 1 year, those are called as money market instruments, right? And which are on the little higher side and beyond 1 year, those are called bond markets or debt market or fixed income, because they generate a fixed income for us for a longer period of time, right? And what actually the bond market does is they give an access for the long term capital to corporates and government, because the government or a corporate or anybody for that matter can raise fund for a longer period of time. Anybody does not means that you and me can go and raise funds in the form of bonds. No, that has certain criteria that we'll understand now. And it allows or it helps corporates to raise fund for various expansions and development. So whatever development, like government has a development plans, government wants funds, they can go to the bond market and they raise funds by issuing government securities. Similarly, corporates, if they want to expand, like we took an example of 5,000 crore companies which want to expand to 30 states, and to expand it to 30 states it definitely needs money. So it can borrow in the form of bonds also. It can issue bonds which will give certain returns to the investor, and the company will also get the funds and company can grow, and slowly and gradually company can pay off, right? So they help in raising funds also. So recently, one of the issue which is in talk is HDFC is coming up with a 10,000 crores of bond issue, right? They will be coming. Now the markets, when we talk about markets, are definitely of two types: primary and secondary. So Ananya, have we discussed, because you were there in the both the class? Have we discussed primary and secondary?
Yes, sir, we're there.
Suraj, you are okay with that? You know it? I mean, rest other four, unfortunately, the majority over here is they don't know.
Yes, sir. Yes, sir. Primary, secondary, I know.
Because this is for the first time that majority was not in that class. So for we'll start with the very basic thing, what exactly the primary market and secondary market is. Here, primary bond market we are talking about and secondary bond market. But first of all, we understand what exactly marketplace is and what exactly primary and secondary market is. So like whatever for our daily consumption, let's say I want a t-shirt, I want let's say a bearing for my car, or let's say I want goggles or whatever thing. So I will go to a market to buy that thing, right? In the same way, we have markets for investments. So we get every investment listed in the listed space where these instruments are being traded. So when we get our daily use things or the things which we want on a physical basis, we go to the market. Either we go to physical market or we go to Amazon, Flipkart, Myntra. These are also marketplaces. In the same way, when we talk about the investment, they have a market where these are being traded or being issued, right? Here, markets are classified majorly in two parts. One is primary market, second is secondary market. In primary market, what happens is issuer sells directly to the buyer, or issuers directly deals with the investor. That does not mean that issuer will go to the home of an investor ki I am giving it to you, you take it. To understand it in a simple way, let's say Reliance Industries is coming out with a bond issue, right? They want to raise funds. Let's say they want to raise 10,000 crores. So who will be the investors into it? We as a retail investors will be taking it. The face value of one bond will be costing somewhere around 10 lakh rupees, which is the minimum amount to buy one unit. So one bond is costing 10 lakh rupees. So it will be invested by the investors who have that much of money, who can invest like 1 crore, 2 crore, 10 crore, 50 crores, like that. And in this way, they will collect 10,000 crores. But practically, it is not possible for Mukesh Ambani to go to HNIs and ultra HNIs each and everyone's house and ask them to buy these bonds, because first he has to convince them, right? Now the thing is, as per the regulations, they have very limited period for that offer, and during that offer, they have to get their subscription. They have to get the funds and their offer to be subscribed fully. So in bond market, what does they do is they issue these bonds to brokers. Then brokers distribute it to retail investors slowly and gradually. So here brokers get bonds from the issuer, which is Reliance Industry in this matter. Broker is the investor. So broker is directly dealing with the Reliance Industry. And they have taken bonds from Reliance Industry. So for them, this particular transaction become primary market transaction, because issuer, which is Reliance Industry, is directly dealing with the broker, which is your the investor in this case first. So they are dealing directly. They are conversing what is the term, what exactly interest they will be giving. Everything is being discussed between them. So this is the primary transaction because issuer has given to. Now broker has taken a lot of bonds from the Reliance Industry, and now broker is distributing these bonds to investors like you and me, who wants to invest into the Reliance funds, maybe 10 lakhs, 20 lakhs, 1 crore, 10 crore, whatever it is, we will just buy that from broker. So this particular transaction is called as secondary market transaction, because we are investor right now, and who is the distributor? Broker is the distributor. But is the broker an issuer? No, broker is not an issuer. Broker is just a distributor. So broker is first taken that bond into his custody, then he is distributing it to us. So this is a secondary transaction. If I have bought that particular bond, since I know a market little more than you guys, and I know this opportunity, I have bought this bond. And after 15 days, when I come to college and you came to know that this was a wonderful opportunity and we should have also taken it, now you want to take it, but you don't know any broker, right? You know, okay, I have taken it. So let's say Elster for that matter came to me and said, sir, I want to buy this bond. Can you sell it to me? I will say, okay, I will sell it to you. I sold that bond to Elster, right? This is also a secondary transaction because I am not the issuer of the bond, but Elster is an investor. So Elster is an investor. I am just a distributor. So bond is only changing hand. Elster is not directly talking to the issuer. So this transaction where issuer is not directly conversing with the investor, then that transaction is called secondary. Where issuer is directly conversing with or directly dealing with the investor, then that transaction is called as primary. ये primary और secondary समझ में आया? Everyone? Anirudh, Ayan, Harsh?
Yes, sir.
Okay. So now this primary and secondary does not only mean in bond market, it is in the equity markets. All the investment instruments are traded in primary and secondary. In equities, what is the example of primary market? IPO. Because companies issuing for the first time. FPOs, buybacks, bonus, share split. These things are being traded directly between issuer and the investor. Whereas we buy any stock in the market, if I want to buy Reliance Industry today and I went to the market and I bought Reliance shares, that is a secondary market transaction because I have not dealt directly with the issuer, but I am dealing with directly with the investor or other investor distributor. I am not dealing directly with the issuer. So that is a secondary market transaction. So majorly when we deal in the secondary markets. Primary markets, we don't deal much except for the IPOs, bonus, split shares in the equity side. In bond markets, dealing in the primary market is little difficult because if a issuer is coming with 10,000 crores of issue, definitely individuals don't have that much capacity. So what happens is usually brokers come into play and brokers buy that issue. And it is not only one or two broker that they come. There is usually 4 to 5 brokers as the amount as it depends on the size of the issue. If the issue is 500 crores and one broker can take all 500 crore, the one broker can take. Who are these brokers? These are the authorized brokers. So in India, we have like AK Capital, Phillip Capital. These are the two major, on JM Financial. These are three major brokers in terms of bond markets. They bid very heavily.
So could you repeat that?
Uh,
The names you just mentioned.
it is Phillip Capital, AK Capital, and JM Financials. These are the three major brokers. Does that mean there are no other brokers? No, there are other also. Correct. Treasuries of bigger bank also bid for such primary issues. Treasuries of like ICICI Bank, Axis Bank, HDFC Bank, they also buy these bonds to make money. So in the primary issue of bonds specifically, usually brokers and treasuries deal into. Individual investors don't deal into. But indirectly, individual investors also deal. How? For example, HDFC is coming with the issue of 10,000 crores, which I know, which you also know. Let's say right now, who all are present over here in this particular class, everybody is millionaire and billionaire. Everybody has 1 crore to spare about minimum, right? Since Ananya ma'am is having a bigger chunk, which is somewhere around 100 crores. So Ananya ma'am's broker came to Ananya ma'am that HDFC is coming with bond issue, which is giving good returns and everything is wonderfully good. Would you like to invest? Ma'am said, okay, I would like to invest 100 crores. Broker is going to bid. Ma'am is not going to bid, right? So what happens is ma'am has given her investment amount 100 crores. Similarly, everybody has given 50, 100, 30, whatever our capacity is. So broker has taken commitment from the investor first, and now broker knows that he has a commitment of, let's say, 5,000 crores. So he will go and he will bid, let's say, 6,000 crores. So 1,000 crores he can bid out of his pocket. 5,000 crores, he has commitment. He just has to take from here, issuer, and simply distribute it to the investor. So this is what the broker has to do. So in this way, actually, we as an investor are getting it directly from the issuer. But again, the transaction is not direct between issuer and the investor. The transaction is via broker. So we cannot say that this is a primary market transaction. But in some context, we can say I have bought it from the primary market. That means when issuer was issuing, I have got it directly at that time but with certain brokerage attached to it or with certain premium I have paid to get it because broker was in between to it. Got it? So in this way, we can say to some extent that the primary market issue can also be accessed by the retail investors. But in bond market, it is usually that retail investor invest through secondary market, not primary market. Got it? Also, did I answer your question?
Sorry, sir.
Did I answer your question?
Yes, sir. Yes, sir.
Great. So primary bond markets issuer sells directly to the buyer. Issuance of new debt securities. Usually, new debt securities are issued in the primary market, right? Secondary market trading of the bonds bought in primary market. जो भी primary market में buy किया है उनको अपन trade करते हैं secondary market. And brokers help in trading, buying or selling of the securities. So usually you get help of brokers in bond markets. When we talk about, you get brokers in between who help you. So like right now I'm working with a private bank, so I'm a private banker. My work is to suggest investment instruments to my clients. I deal with HNI and ultra HNI clients. I suggest instruments which are beneficial for them as per the market situation, as per their risk profile. So in the same way, if they want to invest into debt market or fixed income market, I suggest them bonds and I help them procure that. Can they buy it directly from the market? Definitely they can buy it directly from the market. Can they buy it from other brokers? Definitely they can buy it from other brokers also. Should they buy it directly only from me? Not necessary. They can buy it from anywhere they want to. The issue with the bond market is it is not that liquid as our equity market is. For example, if I have bought a share of Reliance Industries today and I want to sell it after 1 day, 1 hour, 1 year, 1 month, anytime, I just have to simply go and click the button because I know there are lakhs of buyers which are ready to buy it, right? In bond markets, this doesn't happen. In bond markets, what happens is you don't know whether your order will be executed in a day, in a week, in a month, or in a year. You don't know that because in bond markets it is a long term commitment, so usually buyers or the investors are not interested to trade it off. Who usually trades it? Treasuries trades, because they are happy to make small amount but in a bigger lot sizes, right? So they trade more, and the bid and the ask difference is much. Do you understand what exactly bid and the ask difference is? Does everybody understand? No. Okay, let me see if I can make you understand or if I can give you an example. Let me stop sharing first. I'll make you understand. अच्छा, by the time you must be wondering कि इस पे KD Sushma क्यों आ रहा है? इस पे KD Sushma इसलिए आ रहा है because I have borrowed this thing, because I have Zoom access of only 40 minutes free access. She is my partner and she has unlimited access. Good.
Your ask is selling price and bid is selling price.
Correct. So we'll just understand from this example. Is my screen visible to everyone?
Yes.
Yes, sir.
So we are taking example of Reliance. So let's understand Reliance only. Here on left hand side, you can see 25, 27.40, 0.50, 0.85 prices changing. Here it is, we are saying 25.27 or 25, 27.0079, something like that. This is offer. That means a seller wants to sell at this price. So somebody wants to sell at 25, 28. Somebody wants to sell at 25, 28, 30. Somebody wants to sell at 25, 28, 90. So prices coming down and up, right? Difference between the first bid and the first offer is very less. 25, 26, 25, 26.05. 5 paisa, 10 paisa, 20 paisa, nearly 1 rupee. But in bond market, what happens is this difference is huge. This difference could be thousands, 1,000, 10,000, 5,000. It could be small also. So the higher the difference. So let's say you have bought a bond at 10 lakh rupees, 50,000 rupees, right? Now you want to sell it, correct? So you have placed an offer ki I want to sell it 10 lakh rupees and 60,000. But somebody, due to market condition, demand has reduced and somebody wants to buy it only 10 lakh 30,000. Will you sell it? No. you will reduce your offer at best to 10,50,000. You say कि 10,50,000, at least 50,000 I have given premium to procure it, so at least मुझे वापस मिलना चाहिए. So unless you find someone who is ready to give you 10,50,000, your order will not execute, right? Here somebody is taking a 10,30,000. If market condition improves little more, then definitely he will reduce his bid, which would be 10,20,000, which would be 10,10,000, which would be 10,25,000, whatever it is. So ultimately you don't know when you will be getting it. And here I know that I have 2,53,000 people, 2,54,000 for that matter, are ready to do the transaction, and 3,31,000 people are ready to sell. Prices are different, but at least this much people I have. What is the volume? 12,51,000 orders have already been executed. This much amount has already been executed in the day. So that means I have lakhs and crores of investors who are ready to deal. Maybe a little price here and there I will get from some buyer or seller for my order. But in bond markets, usually this doesn't happen because the liquidity is not there. Liquidity means the buyers and sellers are usually not available. Was that clear to everyone?
Yes, sir.
Anirudh, Ayan, Harsh?
Yes, sir.
Yes, sir.
Okay. So in this way, when we discuss, so in bond markets, liquidity is a big issue for bond markets, right? Usually it is not easy for a person to sell on the bond markets. Can he sell on the deep, like we are doing transactions of the equities on the exchange, can he do that with the bond markets? Yes, he has the option to do it. But will the transaction go off? Can't say that, because liquidity will be a bigger issue. It can, it might not, right? So that is a challenge in the bond market. Now, when we talk about the bond markets, then definitely debentures is one thing which we need to understand what exactly is debenture. So debenture is nothing but something similar to bonds. So it has everything except the securitization condition, that what will happen in terms of the failures, right? They are unsecured. Bonds are sometimes secured, sometimes unsecured. It can be anything. So NCD, non-convertible debentures, are also called as bonds, because debentures are of two types, convertible and non-convertible, which we discussed. Like convertible is something which where an investor has an option to convert it into the equity, provided it has been discussed prior with the issuer. If you want to convert it into equity, that and if you have that option, then that particular bond is called as, or debenture is called as, convertible debenture. If it does not have an option to convert into equity and it will be directly getting expired or it will be matured and your principal amount will be back, then that particular debenture is called as non-convertible debenture, which is NCD, right? Now, why does a company or a corporate take from the bonds? Guys, just a moment. I have to take this call. Huh? I'm so sorry. Sorry, guys. It was little urgent and important, so I have to take it in between. So basically, when we are saying debentures, so this is why company actually needs funds. Company needs funds for majorly two things. One is working capital. Second is capital expenditure. So do you all understand these two terms, or do I need to elaborate a little bit
So
specifically
did
this
you say
question?
capital expenditure,
Sir,
capital expansion?
Capital expansion.
Expansion, okay, sir.
Huh. So everybody understands this term? I mean, these two terms?
yes, sir.
Yes, sir.
Anirudh, Harsh, Ayan, since you are guys from, you guys are from engineering BTech, so that's why I'm asking you again. Ayan and Harsh, specifically to you guys. ये pure BTech में चल रहा सर. Logged in and gone off. Harsh and
Sir,
Ayan,
एक बार explain करो.
हाँ?
So explain करो आप.
हाँ हर्ष एक बार कैमरा ऑन करो प्लीज. लेट मी सी योर फेस. लेट मी if it is convenient to you. I'm sure you are at your room and at ease.
फिर मैं लैपटॉप छा देता हूँ फिर कर
अच्छा
देता
चलेगा, कोई इशू नहीं है. सो थिंग इज आई जस्ट वांटेड टू कन्वे ओवर हियर कि आई अंडरस्टैंड यू आर फ्रॉम बीटेक एंड बहुत सारी चीजें ऐसी होंगी जो आपने नहीं समझी होंगी या आपको नहीं पता होगा. तो माय रिक्वेस्ट इज, दो इट इज योर राइट ऑलरेडी, माय रिक्वेस्ट इज कि यहाँ पे डोंट थिंक कि व्हाट अदर 5 पीपल आर थिंकिंग और व्हाट दे विल अंडरस्टैंड और नो. यू जस्ट आस्क द क्वेश्चन कि मेरे को नहीं समझ में आया, बेसिक से बेसिक चीज भी समझ में नहीं आई, जस्ट आस्क इट. राइट? Don't let it pass, because if you let it pass, then there would be I would say no use of taking this subject, because this subject is very much practical. Even if you're not designing any product, even if you're not taking any what you can say job in this field, still this is something which we are discussing for your life. If you understand this subject thoroughly, it will help you to streamline your personal finances also. So pay attention. If you're not getting anything, you can ask me anytime, anything. Not an issue. I can stop the class. I can tell you first, because that is what my job is. Right? But again, this is my request. Choice is yours, what you want to make it. But again, I'm just considering that you all know. If you don't know anything, do let me know. Because otherwise, loss will be yours. Okay? Acha, he's coming from this thing. I'm assuming, Harsh, you missed out what I was talking about.
I heard it. I couldn't hear about your question.
Okay.
Yes, sir. I'll ask the doubts if I come across it.
Please do that, because I don't want you to be unaware about the basic finances after this subject at least. Right? And convey the same thing to Ayan also. Looks like he is logged in, but probably might not be able to do it. Okay. Yeah? Okay. Chalo, great. So why does a company borrow money? Company borrows money for majorly two things. One is working capital, day-to-day expenses, and second thing is capital expansion. So what does these two things means? If a company wants to run, it will buy some raw material, it will convert that raw material into a finished good, it will sell into the market, and it will get some money out of it. So to buy raw material, company needs money. To process that raw material into a finished good, again company needs money, utility bills, salaries of employees, and a lot of other consumable items, everything. And then that product will be converted into finished product, and which will be sold in the market, right? So to convert a raw material into a finished good, company needs money. Now, when company sells that product in the market, not necessarily that company gets money on the same time. At the same time, it might get it after 1 month, 2 months, or 3 months, depending upon the credit period. After that, they will get money and they will pay off their equity. To the expenses what they have done it for the raw materials and other things. Some expenses are paid on that at that particular time. For example, salary has to be paid on the first of the month. You are getting proceedings after 3 months or 4 months. You cannot hold salary for 3 months or 4 months for your employees, right? So you need money to run these expenses. These are called day-to-day expenses. And the cycle from procuring raw material to getting proceedings, this cycle is called working capital cycle. That in how much time you convert your raw material into money, raw material to finished product, to selling in the market, to getting that money back and paying to the raw material or to your creditor, or to your creditor, right? So that is what you call as a working capital cycle, and whatever amount is required for to maintain that working capital cycle is called working capital expense, right? So sometimes that particular working capital cycle, it actually depends from industry to industry and company to company. Few companies have working capital cycle of 15 days. That means within 15 days they can do these things. I mean, they can take raw material and they convert it into finished goods, sell in the market, they get back money in 15 days. That is their cycle. Few industries, they have a working capital cycle higher than 1 year. For example, shipbuilding, aircraft industry, they take years, at least 1 year, 2 year, 1.5 year to convert into finished product and sell it and get money, right? Usually on an average, when we talk about the manufacturing company, a 3 to 6 months working capital cycle is considered good. So maximum you will find 3 to 4 months working capital cycle. That means in 1 year, their cycle can repeat 3 to 4 times. That is the average, I would say, for maximum industries. There are shorter cycles, working capital cycle industries also. There are larger working capital cycle industries also. Depends upon company to company, business cycle to business cycle. It can vary. Second is capital expansion. So capital expansion is something where you want to expand your company. So as we took an example of 5,000 crore company, which we want to expand it to another 30 states. So in that matter, definitely we need to have offices, we need to have a lot of machineries and a lot of other things which we need to buy, and which is one-time investment. Because if we build an office, we are not building an office every 3 months or 4 months. We'll build it for 12 years, 20 years, 30 years, 40 years. If we build it, we build it. Maintenance, definitely we will keep on doing certain interior, certain small changes, but that is not in capital. So whatever we do for a longer term, that is called capital capital expenditure. Whatever expense we do into it, so we call it as a capital expenditure. And this expansion is called a capital expansion, or simply expansion. So when we do an expansion where we build fixed assets majorly for a longer period of time, there we call it as a capital expenditure. So company needs for capital expansion, which uses capital expenditure and working capital. For these two things, company needs money majorly. So when company is requiring money for longer period, they go into NCDs for a longer maturity, 10 years, 15 years, 20 years, like that. When they need money for shorter period, they go for the shorter, majorly in the money market stream, where they get money for shorter period and they just run their working capital cycle. So whenever company is requiring any funds, this particular, why is that particular thing which they have to define, and that is defined in the indenture. Why they are using, why they are requiring this money, this they have to very clearly specify. So they specify why they are requiring money. If they are securing it, then definitely it might come under the category of bond. But usually these are, as I said, these are investment for us and borrowing for the issuer. In that case, guarantee is usually not given, or it is not secured. So majorly bonds are unsecured. Majorly bonds are not secured, unsecured bonds. That's why it is called unsecured bonds and non-convertible debentures also, right? It does not have any burden of asset for the issuer, because issuer has get an investment. I'm so sorry. Issuer has got an investment where guarantee of giving it back is there on papers. If the issuer goes bankrupt, then definitely it is not liable to pay back. So if issuer goes bankrupt, in that case, what happens is the primary debt, which is secured, will be given first, will be served first. If let's say a borrower is having a debt of 100 rupees, in 100 rupees, 50 rupees it is borrowed from bank. Bank has taken collateral security of its assets, right? 50 rupees it is raised from the markets. Out of that 50 rupees, 30 rupees is from bonds, 20 rupees is equity, right? In this way, 100 rupees are borrowed. So sorry. In case company goes bankrupt, in that case, assets of the companies will be sold first. Out of those assets, whatever amount comes, so the debt part which is secured by financial institutions or by any other institution also is called primary debt. That will be served first. So primary debt over here in our case is 50 rupees. So let's say the assets were sold worth rupees 80. So 50 rupees will be given to the primary debt. We are left with 30 rupees. And how much debt company is still left with? 30 rupees of NCDs, bonds, and 20 rupees of equities. That is something which company still has to pay. But the amount is left is only 30 rupees. Now 30 rupees left. So this 30 rupees will be given to the bond holders first. They are debt holders. So bond holders will be given first over here, served first over here. So this 30 rupees will be given to the bond holders. Equity shareholders will not get anything in this particular case because nothing is left. So that's why equity is, you can say, partner in crime. So If it gets profit, it gets very high profit, gets loss, it gets very high loss, right? In the same example, let's say, because NCLT is the agency who will be taking care of it. So there is a fees attached to the NCLT also. After selling all the assets, company's assets, the amount which was realized was 80 rupees. NCLT's fees is 10 rupees. So first fees will go to NCLT. So 10 rupees are taken by NCLT. Now there is left only 70 rupees. Out of this 70 rupees, 50 rupees will be given to primary debt. So primary debt holders will be considered first after NCLT or after the commission or after the, you can say, what you call it, the agency who is doing this particular thing, right? So that will be paid first 10 rupees, then 50 rupees to the primary debt holders, primary lenders. Now we are left with 20 rupees. This 20 rupees will be given to NCD, any bond holders. And since it is 20 rupees, bond holders are invested by 30 rupees. So it will be divided as per the ratio of investment. Somebody is having 10%, 10% of 30, somebody is having 15% of 30. So they will get 10% of 20, 15% of 20, like that. Shareholders, equity shareholders will not get anything in this case also. Another example, after selling everything, if the proceeding received is 90 rupees, NCLT takes 10 rupees first, primary lenders takes 50 rupees, that makes 60. Remaining we are having how much? 30 rupees. So bondholders will be given 30 rupees completely. Even if after selling we get 100 rupees, 10 rupees by NCLT, 50 rupees by primary lenders, 60 rupees, 30 rupees by bondholders, 90 rupees. Now only 10 rupees is left and 20 are the shareholders' money. So 10 rupees will be divided into shareholders as per the ratio of their investment, right? So equity shareholders get only left over, nothing else, right? Since they are unsecured, so just let's take an example. Bank's FD is secure till the amount of 5 lakhs. Let's say you have 20 lakhs to invest into. You have 4 bank accounts, 4 savings bank accounts in 4 different banks, HDFC, ICICI, Axis and IDFC First Bank for that matter. In every bank account, your 5 lakh rupees is secured. That means guaranteed. Now bank is giving you FD rate of, let's say, 7%, right? You have a bond or a debenture for that matter, which is unsecured, and that is giving you, let's say, 11% of rate of interest, or let's say 7% of interest for that matter, or 8%, not 7, 8%. Where will you invest?
So could
FD.
FD, okay. Elsewhere, what you're saying?
so I couldn't hear the what
Okay,
you said properly.
so
Could you repeat?
let's say you have 20 lakh rupees and you have 4 savings bank account, ICICI Bank, HDFC Bank, Axis Bank and IDFC First Bank. Since we know that RBI only guarantees 5 lakh rupees, you want to invest this 20 lakh rupees in fixed deposit, you are getting 7%. All the banks is giving you 7% of return, right? On the other hand, you have another instrument which is called debenture, which is giving you 8% of return. So where will you invest your money in?
Debenture.
Okay.
So is it a non-convertible debenture or a convertible debenture?
Irrespective of it, you can consider any. It is
Sir,
Okay,
both
then
of them
yeah,
are the time
debenture.
period for the same are the same.
Time period
like
is
the time
same, it is non-convertible. They both have the same. I mean, you will get the same maturity. I mean, after a year, your amount will be matured and you'll get the same amount back. You'll get the interest at the rate of 7% terms of FD and 8% terms of bond or debentures. So where will you invest into?
So, but I think here there's another factor, right? That if it's a convertible debenture, then obviously, like in case of a bankruptcy, I get put last, so there's a chance I won't receive anything at all. Whereas in the case of a bank, at least like I get like a 5 lakh amount after it goes bankrupt.
Correct. The point over here is that since I said you have 20 lakhs and I gave you 4 banks, that simply means that you will split your amount. If you split your amount 5 lakhs each in every bank, your amount gets 100% secure, right? You get 7% return. That is also secure now because banks are not going to default. Though we cannot say that nobody can default, everybody can default, but again, the probability of default is very less. Even if default, you will get your principal back in all 20 lakhs because you have 5 lakhs each in all the 4 banks. And RBI takes guarantee of 5 lakh each per bank, right? So you got 20 lakhs completely secured. In debenture, it is unsecured. There is no guarantee at all. And if company goes bankrupt, then definitely you are not getting your principal back or your interest back in any case, right? In any case, if the company or the bank goes bankrupt, the first thing which will go off is your interest part. So interest part will go off and you will not get back. So if you're taking higher risk, so definitely you will require higher returns. So if you are getting 8%, you will not go with 8% option. The simple reason is because for going for the 8% option, you are actually taking a risk of all 20 lakhs of your capital. Though virtually it is risk free because you're investing in a good company where the credibility is good, everything is there and it cannot go to zero. But in investment, we say that irrespective of the you can say percentage, that is 0.0000001% also, but it has the probability to go to zero. Even Reliance also has a probability to go to zero. With this COVID period, we have seen, leave aside Reliance, countries are going to zero. Countries are defaulting. US, for that matter, was on the verge of defaulting in the debt. Somehow they raise the debt ceiling. This we'll understand, this we'll discuss as a case study, right? So anything can happen. A company, for that matter, I think the fourth largest bank, SVB Bank in US, that went in default, right? And in this COVID period only, I mean, couple of months back only. So anything can happen. Any company can go to bankruptcy anytime. So your money is at stake. But here, in term of bank, RBI is taking a guarantee. That means sovereign guarantee is there. In case bank fails, RBI will give it to you. Now the question can come कि अगर RBI fail हो गया तो my simple assumption, my submission to this is कि RBI fail हो गया तो पैसों का करोगे क्या? पैसे लेके करोगे क्या जब कंट्री पूरी की पूरी फेल हो गई है, right? Because if RBI is failing, that means our economy has failed. So in that case, we will not get anything, and money लेके करना भी कुछ नहीं है. That money will be only papers. It won't have any value to it. So here the point is कि if you are getting coupon rate equals to the bank one, so definitely you will not be investing in unsecured. So if your security is on stake, that means if you're taking higher risk, then definitely the returns should be higher to compensate that risk taking, right? So in debentures, you get higher coupon rate. So bank is giving you fixed deposit rate of 7%, then definitely you will be getting somewhere around 9%, 10%, 11, 12%, depending upon the credit rating of that company. That higher returns also you are getting in the market, right? Bonds may we'll continue this thing in our second class. Probably today evening only I'll take if is it okay if I inform you somewhere around 5:30 or 6 that we'll have a class at 7? Would that be okay with you? Everyone?
Yes.
Yes, sir. But sir, will the class be online or offline?
No, online. As of now, I'm not coming to campus. I was supposed to come campus. It is right now I'm taking online only. Majorly, we will be having online classes. I'll be coming to campus 2 to 3 times. I have already come one time, so another 2 to 3 times I'll be coming to the campus. Since I stay in Mumbai, so practically for me it's not possible to visit campus every time. So my classes most of the time will be online. But whenever I'm coming to campus, be ready to get grilled because I take long hours classes. Anirudh, you might have heard that, didn't you? You were there in the class when Anil called you?
No, sir.
Anil Vishnu was talking to the other person. Who was that person? Who was there?
Vedant.
Vedant, correct. Huh? So usually I take long hour classes. So be ready for that. When I'm coming to the campus, you will be grilled. So being a senior, I am just taking you can say that this is the way of taking ragging of juniors. I take ragging in this way. Okay.
So the previous 2 classes, were they online or offline?
So previous 2 classes were offline. They were
Okay,
not
sir.
online. Yeah. So we'll continue this today by evening. I'll confirm you by 5:30 if I'm able to take it or not. If I'm able to take it, I will definitely take it. And if I'm taking it today, so be assured that 99% tomorrow I am not taking it. Right? If I'm not taking it today, then there's a chance that tomorrow I'll take it. So that is again the benefit of you, that you will get a good sleep tomorrow in case I'm not taking it today. Right?
Yes, sir.
Chalo. Is it a great deal or not? Looks like nobody's interested. Ayan and Harsh, which stream you are in BTech?
The Ayan is IMBA.
Acha, Ayan is IMBA, sorry. I always... We have two from BTech, na? One is Harsh. And who is the other one? Vedant.
The Anirudh.
Anirudh, okay. Anirudh, you are from which team? Network issue. Why there is no name at all? Okay, today is 11th August. 11th August and 8:30. D14, D1L, बाप रे. अच्छा, ये तीनों लेने पड़ेंगे मेरे को, right?
Yes, sir. You have to take all of them.
All of
And like you can take the timing as well.
yes, that thank you. So Elster is there, Ananya ma'am is there, Ayan is there, Shreen ma'am is there. Where is Shreen ma'am? She's not well?
Not sure.
Not sure.
Sir, also, can you just call me Ananya?
Unfortunately, I cannot take this request because this is the practice which I've developed. I always respect your womanhood, so I always will call you with ma'am. That is my bad habit, you can say in your terms.
Okay, sir.
I hope you don't mind in that case. It's giving you headache.
No, not. It's kind of new, so.
No, that has been my habit, because of my profession or whatever you call it. So that has become my habit to do it. So attendance marked for all 6. Rest 2 were
Yes.
not there. Let's stop recording.